What's going on, guys? Welcome back to another video here. We're bringing back the daily market recap videos, so if you guys are interested in these and you're excited for these to come back, please drop a like down below, drop a comment. We're going to get the YouTube algorithms turbocharged again. We're going to help people obviously understand the markets in a way that is absolutely necessary if you want to have long-term success trading the markets or investing in the markets. I say this all the time. If you think that you're going to have some little cookie cutter setup that's going to print you money over time, well, think about it logically. There'd already be billions of dollars of money running through a strategy like that, and there's not. So what you need to understand is that information is the edge, and that's what I am here to help you guys out with. So for this first video here that we have back, I mean, we have a lot to talk about. There are some very significant risks in the market that we are witnessing, but without further ado, let's get right into it and recap a little bit of what's happened today with CPI. So some are going to be looking at this CPI report here and saying, well, that's relatively good. We saw PPI yesterday coming in lower than expected, and we are seeing something similar happen across the board with CPI. We saw a 2.9% increase instead of the 3% estimate. We also saw on core 3.2% versus the 3.3% estimate. Now, yes, inflation coming down is good, but as you guys are going to see as we go through this video here, the market's expectations of what's going to happen next are incredibly important in basically making sure that this market stays intact, but we're going to get there in a second. So I know a lot of you guys have talked or seen people talking about the yen carry trade. We've been talking about this for a while. That last VIX Insights research report I gave for you guys back in, actually there's been a few of them, but one of the most recent VIX Insights research reports was talking about how Japan was the catalyst for markets significantly moving to the downside. Now, along with this, we are also starting to see some recession fears in the US starting to pick up. When we did receive that last NFP report, recession fears were triggered when last Friday's US jobs report for July showed a rise in the unemployment rate to 4.3% from 4.1%. This was right before and right around the same time that the Bank of Japan decided to raise interest rates by 0.25%. Now, what's interesting about this is that the market's reaction to that, obviously, as we have all seen, was very negative. So what that really means is they didn't give any guidance to this coming, really, and the market did not see it coming, and neither did the Bank of Japan. And that's why I'm saying now that there's a possibility that the Fed doesn't necessarily understand or see this is situation brewing. Now, when we move over here, remember, I want you guys to keep in mind recession fears. If there's recession fears building, there's going to be higher expectations for more and more aggressive rate cuts coming in the near future. Now, when we think about this carry trade here, I'm going to assume that you guys have all kind of gotten a good understanding of this. We could do a whole nother video on the carry trade if you guys want to. If you guys do, just comment down below. But the interesting thing about this is that JP Morgan came out and said that 3/4 of the global carry trade had been unwound. Now, for those of you guys that know, I mean, this has been a decade-long trade and is absolutely massive. When we come over here, again, it's as much as possibly $4 trillion that's in this trade right now. And there's that $1.1 trillion to pay off the yen carry trade borrowing, which is effectively that $1.1 trillion margin call basically across the world. So if you then think to yourself, they had a $4 trillion trade that was going against a lot of these large funds, and they unwound that in a matter of a couple of days, I would say that's incredibly unlikely, and we still have a lot of this trade out there, and more of these hedge funds continuing to go into this trade because the difference between these interest rates in Japan and what they can get in the US, there is still a spread there and some quote-unquote free money that they can take advantage of. Now, okay, what do we have? We have this carry trade brewing. It looks like all of the kind of craziness that we've had with it for now is over. We also have some of these recession fears building in the United States. Now, what is that leading to? Well, obviously, we can just prove it right here that the target rate probabilities for the end of the year at the last FOMC meeting is about 4.25% to 4.5%, and we're currently at 5.25% to 5.5%. So what that's telling us is that the overall prevailing thesis of the market right now is that we're going to be getting about a point or a percentage of cuts by the end of the year. Now, what would that actually kind of shake out to at each individual Fed meeting? Well, let's see how many of these Fed meetings are left. September, November, December. Well, that would mean that we would then need to see a 50 basis point rate cut somewhere in here, either at September, November, or December. So these rate cut expectations are relatively high. Now, you're going to hear a lot of individuals out there talking about how the Fed is behind the curve. Now, while that may be true, I want you guys to think about what we've seen really just over the last 2 years here. We all know that the Fed was behind the curve when they started to raise interest rates. Now, at face value, they should have started raising interest rates sooner, but they didn't. Why? They would have bankrupted the Treasury. We all knew that there was trillions of dollars that needed to get basically refinanced or rolled over of United States government debt. And if the Fed aggressively was raising interest rates to even higher levels than we are at right now, we would have an even bigger issue with all of these interest payments that the United States has to pay. Is that a bigger issue to the world economy than the Fed being behind the curve? Well, that's the decision and the side that the Federal Reserve has taken. So when you hear people say the Fed's behind the curve, yes, they might be, but at the same time, we have to think about what happens next. So the other thing I want to point out here is when we look at this 4.3% unemployment rate, there is an argument to be made as to why there are some of these recession fears brewing, because at the last summary of economic projections from the Fed, we do see that the expectation for the unemployment rate by the end of the year is about 4%, and we came in much higher than that. So these fears are warranted. Now, to what extent? I mean, all of those rate cuts, some of the expectations are actually showing 1.25% of rate cuts by the end of the year, which is very, very, very aggressive. So I want to play this out for you guys very quickly before we get into kind of the broad market here, looking at what we are seeing on the key indexes. So option one is that all of these market expectations are correct. Okay, what happens? Let's just play that out. The Fed's behind the curve. They're going to try and catch up and do some of these big rate cuts. Well, when you cut rate, when a Fed central bank goes out and cuts rates, the domestic currency is going to lose value. So you can just see right here, in other words, rising rates underpin a stronger US dollar versus foreign currencies. And the exact opposite is true here. The opposite dynamic, falling interest rates, tends to be dollar negative. Okay. So if the Fed is going to cut interest rates aggressively, the dollar is going to weaken versus other currencies. And you could look at it the other way. Some of these other currencies are going to strengthen versus the dollar. Now, what does that do to the USD JPY chart? It sends it much lower, putting the carry trade at even more risk of further unwinding. Now, the unwind of the carry trade, or even a weak dollar, is going to be what's called repatriation, meaning that large investors are going to be taking their money from the US markets, mainly foreign investors, from the US markets and taking it back to their domestic countries, converting it back to their domestic currency. So if that starts to occur, which is very likely if the Fed were to cut rates aggressively right now, then we would see another round two of this carry trade unwind craziness volatility that we've seen in the markets. So that's option one, with everything staying the same. Now, if everything stays the same and the Fed ends up not cutting by what the market is expecting right now, remember, we have recession fears. If the Fed is not going to come in and kind of basically give the ability for the market to have more ease of capital, ease of lending out into the system, well, what happens then? Well, the recession fears are still there if the data stays the same, if we have high unemployment, slower growth, as well as inflation moving to the downside. So then what happens? Well, you see selling pressure anyway. And this is why I said at the beginning of the video that these rate cut expectations are so important, and also why that CPI print wasn't necessarily the best, in my opinion. Are we going to see any short-term crazy downside off of that? No. The reason why is that nobody is paying attention to these things. But I want you guys to understand that those are the two most important things that we're seeing in the market. Now, if we can see unemployment start moving back to the downside, we see it balance out, we see some decent growth, we see inflation kind of bottom out here. Well, that would be a good sign, as we could then start to see those those rate cuts, those rate cut expectations moving in the opposite direction. Now, we've seen this pendulum swing in the market many times this year, and it hasn't really been an issue until the Bank of Japan rose their interest rates by 0.25%. Now it's a little bit of an issue. Japan is stuck. They can't raise their interest rates anymore because they know what will happen now if they do. And the U.S. is coming to the position in the situation where it is very likely that we start to decrease our interest rates. The key question is, by how much, and how does that match up to what the market is expecting at that time? Now, I also want to talk a little bit about the broad market right now, what I'm seeing on the key indexes, what we really need to see to confirm a new uptrend before we wrap up this video here. Again, we're going to be doing these about 4 times a week, Monday, Tuesday, Wednesday, Thursday for you guys, so that everybody has a better picture as to what's happening in the market. And as always, if you guys have any questions on what we've covered, make sure you guys drop them down below. In this video here, I'm not going to be going over any tickers at the end. I don't really see a whole lot of opportunity here, but again, with that less trades, more profits methodology that all of you course students have been kind of operating under over the last 8 months here, you guys have seen how powerful it is. We also have our Discord coming out at the end of August, so make sure you guys are ready for that. We're going to be doing everything from day trading, swing trading, stocks, currencies, cryptos, futures. We're going to have single stock analysis research reports, these macro research reports that are going to be just for you guys, very similar to all of those research reports we were doing on Japan when nobody else was looking at it. So again, I can plug this here, but if you guys do take advantage of the 20% off discount that I have to all of my current education, you guys are going to be getting the Discord for free. You're not going to have to pay monthly. Now, let's take a look at the broad market here. Now, I've been saying this on all the public streams that we do. We're live every single day on YouTube, that we need to start seeing some closes at highs in the market to kind of give us a little bit of that inkling that the buyers are willing to take control. We've seen 2 days of this really. But what is notable here is that we are getting some closes above this 10 EMA on the daily time frame, and it is starting to inflect to the upside. Now, what I would like to see here is a little bit of consolidation and to see buyers defending. If we start to see the sellers take control, we see that volatility pick back up. Again, as you guys have heard me say, and a lot of you guys have been saying, there's not a whole lot of trust to be had in this market right now. Now, again, if you're looking at this in terms of a trend line, we are kind of starting to match up with that area right here. I would like to see a test of this 10 EMA on the daily, and we hold it. It is a decent ways away from where we're currently trading here. The 10 EMA is currently right around that 54.03 area on ES. We're currently at about 54.68. But again, this will probably start to catch up towards the end of the week. We also have another key piece of data that I want you guys to be looking out for, which is going to be tomorrow morning at 8:30, which is going to be the jobs report, the initial claims and the continuing claims. Now, for those of you guys that don't know, I don't want to put too much information and overload you guys too much in this video, but initial claims is the amount of people that are filing for unemployment benefits for the first time. The continuing claims are for those people that have previously filed in the initial claims that are still receiving those unemployment benefits. So it gives you a little bit of a precursor as to what that unemployment rate could be, which again is one of the main reasons why we're starting to see those recession fears starting to pick up. Very similar to that BlackRock research report that we briefly took a look at. So it's going to be very important to see how the market reacts there. But to kind of wrap this up in a bow here, I don't want people to think that, oh, I'm just sitting here and being incredibly bearish about the entire market. What we need to do is point out all of the different points of risks that we have in the market. And again, if we start to see those rate cut expectations coming back in line, yields starting to come back up, some of the data starts to kind of balance out, coming in right at some of these expectations that the market has, or even a little bit higher, to me, that's actually going to be a good sign. Most people are going to think is, oh, rate cuts means the market goes up. And you saw it a lot where the market started to drop in these areas and people were begging for emergency rate cuts. And it just goes to show the lack of education and market knowledge that most people have in the market, including UPenn Wharton professors who are coming out begging for 75 basis points of cuts. So Again, this isn't a call for the market to really start knifing, coming down to the downside. Personally, unless we start to see the data really come in way away from some of these expectations on either side, or the Japan situation starting to heat back up if they randomly decide to raise interest rates again, which they've said they're not going to do, then I would expect a little bit of calmness through the rest of August here, and then set up for that potential September rate cut. And then we get closer to the election, which I'm going to have a lot of cool market insights for you guys around there. So team, that's going to wrap it up for this one. Hopefully you guys enjoyed this first market recap video, kind of explaining everything that's going on, especially after today, the CPI report getting released. Again, for this first one, if you guys wouldn't mind going down, hitting that like button, dropping a comment so we get that YouTube algorithm charged up again. I'll see you guys in the next one tomorrow. Peace.